प्रेजेंटेड बाय ईबिक्स कैश, हर खुशी के लिए काफी है।
Hello and welcome to the Business Today Market Special. I'm Udayan Mukherjee. My guest on the show today is Prashant Khemka, who's the founder of Whiteoak Capital Management. Before that, for many years, he was the Chief Investment Officer of Goldman Sachs Asset Management as well. So he's a veteran of many decades in the Indian stock market. Prashant, it's very good to have you on the show today. Let me begin by asking you for a more general sense of the market, because markets have rediscovered momentum. They're moving very fast once again. Are you comfortable, or are you getting the sense that this is a bit of a blowout kind of a bull market where the market might actually end up pricing in much of the anticipated earnings growth and good news well in advance?
Certainly. Thank you, Udayan. First of all, pleasure to be here on your show. Certainly, when market moves as sharply as it has over the last 18 months or so, albeit it started from a very low point, no doubt, but still small caps are up nearly 250%, large caps are up well over 100%. It does give some feeling of discomfort, no doubt. Regardless of the fact that we as a team firmly believe that markets, from a top-down or macro perspective, going in, we believe that markets are fairly valuing all the macro considerations and their fair value of future cash flows and so on. With that caveat, it does feel somewhat discomforting. Reminds me of years like 2006-7 or 2017, particularly when it comes to the small cap segment, where we think it is more heated at this time.
How do you think this will end up, Prashant? Do you see a very sharp correction happening sometime down the line, or do you see a bigger runway of a blowout and the market's getting really heated and elevated in terms of valuations before such a correction might actually materialize?
Certainly. So I would say it's impossible to say, not very difficult, but I'll reiterate, impossible to say. Right now, there is a confluence of fundamental and tactical factors at play, which can argue one can rationalize that justify the current market levels at an aggregate level. So first of all, global multiples are at historical highs as well. So it's not just Indian market multiples, but global multiples. And Indian markets cannot be in isolation with compared to the global multiples. So US markets, which long-term average have traded mid-teens, currently are in the low 20s. Accordingly, Indian markets, which historically on average have traded in high teens, are currently in the mid-20s. So that context of global markets being where they are relative to their historical past is important when keeping in mind where Indian markets are relative to their historical past. We can discuss whether the global markets are themselves carried away or they're reasonably valued and so on, if that is of interest. Now, coming to certain tactical factors, China just recently, few months ago, from an investor's perspective, committed a blunder by destroying several companies or segments of the markets altogether. Maybe it serves a certain domestic policy, but from an investor's perspective, that's highly undesirable. That has made or reinforced what has always been a very strong point working in favor of Indian market, which is the democratic institutions, the judicial framework, which allow corporates to challenge government actions and take even government to the court. So that property rights, laws that we take for granted in India are not necessarily as strong across the global emerging market world. With all their shortcomings that they have in India, they're far better than most of the emerging market world. And that's all of a sudden come to be recognized by the market once again. And that is helping those multiples in breaking away from China as well as from global emerging markets overall. So these are two, when we think of the multiple, these are important aspects to keep in mind. Besides this, corporate earnings, corporate profitability perspective. So one is the multiple and the other is the earnings, which drive the market, as you know. On the earnings front, we after a long time had fiscal year 21, which delivered mid-teens earnings growth after nearly a decade or so. Despite fears of minus 20, minus 30% earlier in the year because of pandemic. And more than just the last year, expectations for this year and going forward are for very robust growth, 25% plus kind of growth this year. Again, a confluence of factors, supply chain disruptions, both domestically as well as globally, have helped consolidation of market share in favor of listed larger corporates. When I say listed larger, not only large cap companies, but even a small cap listed company is larger than vast majority of the mom and pop companies. And so there has been a consolidation in favor of these companies, both in terms of top line and bottom line, that has boosted earnings. And global supply chain disruptions also have caused a boost for several of the sectors in the market, and hence driving the strong corporate earnings growth. So both multiples and corporate earnings have risen over the last 12 to 18 months.
When we started, you spoke about how the small cap index has gone up 250%. I mean, from a tactical perspective, as a fund manager, would it be fair to say that you're feeling more comfortable at the larger end of the market now after such a sharp rally? Could you even have moved some money from maybe down the market cap chain from small caps and mid caps to large caps because of the ferocity of the rally at the lower end of the market?
That is a fair observation, Udayan. And the way it works is not necessarily from a top-down perspective, the portfolio manager on the team making a decision to move the money necessarily. But if the team had done nothing, let's say, just sheerly because of the strong outperformance in the small cap portion of the portfolio might have become twice as large as it was, say, 1.5, 2 years ago, right? But from time to time, as the team evaluates the investment opportunities in front of it, they likely to have trimmed more than they would have added in small caps. As a consequence, the large cap weight of the portfolio has increased compared to the small caps in the portfolio. It's very crucial, I think, at this time. As I was saying, it is more reminiscent of 2006-7 time frame or 2017 time frame, I would say more so, where small caps had such a huge rally. And today's market is up. The small caps are up 50% compared to what they were in 2017. And 2017 was regarded as a multi-year high for small caps, right? So yes, 4 years or less than 4 years have elapsed from the peak of Jan 2018 for small caps, and we're up more than 50%. So the multiples of several of these small caps, particularly you have to be careful if when you look at, certainly not something that the team evaluates or invests in, but at the risk of generalization, in poorly governed companies, there seems to be greater euphoria at this time, which is again coincidental with prior peaks in small caps.
Let me ask you, since you spoke about lower quality stocks, etc., but the end of the market which seems to be really firing now over the last few weeks is the public sector universe. I mean, not just public sector banks, but the Coal Indias, NTPCs of the world have also started moving after a very long time. Usually, high quality portfolios don't have a lot of these names. What about your funds? How are you approaching them?
So at present, we do not own any of these companies. We have historically tended to not have much exposure in these companies globally. I mean, even when I used to manage global emerging markets strategy, we would have very minimal exposure to SOEs, be it in China, Brazil, or anywhere else in the world. That's not much different here at Whiteoak as well. Though we continue to always remain open and never say never attitude, because if we truly are going to enter into a once in a lifetime or a once in an era privatization mode, Air India has recently concluded sale, then there could be certainly opportunities here that would, solve the problematic issues that have kept us skeptical of the space in the past. And so we remain open and evaluate
Would the same,
to
sure.
getting into some of these names.
Would the same extend to something like commodities, where usually we don't see a lot of stocks in high quality portfolios, but
Certainly.
over this year and probably the next couple of years, you would probably see an upcycle in commodities, and we could see very, very healthy cyclical profit generation. Are you cognizant of that? Because sometimes fund managers don't include commodity stocks and then their portfolios underperform in commodity upcycles. Are you cognizant of that risk?
Certainly. So, to be fair, that is a risk that has been a factor or element of my own past performance as well. Though we always never say never is very important approach that we have, and we continue to evaluate commodity stocks, and at some point, and we do have some little exposure there. The reason for commodity stocks not being in the portfolio by and large, or having very low exposure, Udayan, is not to do as much with the views on commodity, but the stock prices are predominantly a function of underlying commodity price, on which it is anybody's guess. Just like equity market cannot be predicted, is impossible to predict. Similarly, these commodity prices are impossible to predict beyond what is currently priced into the markets in the spot market and futures market. So that becomes a key driver of the entire investment thesis, which is not predictable. As against that, let's say when you're evaluating a financial company, where you can bring to bear your expertise on and your judgment on the management quality, execution capability, competitive position of different companies in almost every other sector, be it retail, financial, autos, consumer. You can evaluate business fundamentals, management capabilities to a far greater extent. Those are the drivers of stock price performance over time rather than commodity price, which is completely unpredictable. So that is the reason more than anything else where our portfolio tend to have very low exposure in commodities. But as you pointed out, if we are in some kind of super cycle, we would force ourselves to evaluate the opportunities and take some selective positions where we think expertise can still be brought to bear and it's not completely a guesswork or a punt on commodity prices.
The one area where you seem very, very confident is, converse to what we just spoke about, is technology. And there don't own just the large cap names like Infosys, but I find many mid cap technology companies in your portfolio. Names like Emphasis or Coforge, Persistent Systems. What makes you confident about that end of the technology market?
Certainly, Udayan. See, over the last, I would say, 14 odd years that I've been either leading the teams or the portfolios in India. Private sector financials and IT services companies have historically been fairly good chunk of investment in the portfolio. These sectors have created huge amounts of wealth, not only historically they have created, but going forward also believe represent a large number of opportunities. If you look at IT services in particular, what differentiates one company from another is the execution capability of the team. It's an ocean out there, ocean of business out there. India is still a high single digit to low double digit percentage of global market share, depending on which line of business you're looking at within IT services. Right? Individual companies, like the largest of the companies in India, are low single digit percentage of global market share. So there is no dearth of opportunities. Globally, IT services in dollar terms may be growing at low to mid single digits, but Indian IT services in dollar terms is growing at high single digits. That's in dollar terms. Translated to rupee terms, given the long, expected depreciation of 3 to 4% of rupee, translated in rupee terms, IT services as sector can grow in low double digits to low teens. And within that, the better executing firms, large cap, mid caps, the better executing firms can grow at mid teens to high teens. And some of these strong execution driven firms, not to go into specific names, but some of these strong execution led firms can grow in the 20s for a prolonged period of time. And as a result, we do find, very attractive and obviously valuation combined. Despite all this, despite the run up over the last 18 months, IT services companies on cash flow basis So large cap IT companies remain one of the most attractively valued on cash flow basis compared to other sectors in the market. Similarly, the mid caps and small caps compared to their counterparts in other sectors. And hence the team continues to find great lot of opportunities in these segments.
It's not just IT. You on the export side, you also have a fairly significant bet in pharmaceuticals. There you own not only traditional names like Abbott and Ipca and Torrent, but even slightly newer companies like Gland Pharma. How do you go about picking and choosing there after a fairly significant run up in the sector?
So not all of the names that you mentioned, Udayan, would be necessarily own. The team would necessarily own or have owned historically. But yes, see, pharmaceuticals as well have many of the same characteristics that I mentioned about IT services. An ocean out there, Indian companies still having a very small market share compared to the global peers and having structural advantages. Execution is the key. If you can find managements that can execute very well with good corporate governance in business lines that are to begin with attractive, business segments that are to begin with attractive, you can have a very long sustained period of strong cash flow growth. And many of these companies are not being distinguished from the average in the peer group. IT services, generally people think of IT services in India as a mature sector because NESCOM and these companies guide in dollar terms 7 to 8% growth. 7 to 8% or 9% growth does not inspire anyone in India. Everyone wants at least double digit as like a God-given birthright, if you will. But that 7 to 9% has to be recognized that it is in dollar terms. So rupee terms, it translates to, and same thing for pharma as well, translates to very strong top line, bottom line cash flow growth. And if they're not being recognized in the market, they provide great opportunities.
Let me ask you about autos, another sector where you don't seem to have too many holdings in. I mean, what have you made of the recent excitement in, say, Tata Motors because of the EV announcements? How do you see this whole EV phenomenon as a threat or an opportunity for the sector, and how are you going to play it in terms of your portfolio?
Absolutely, Udayan. Very, very pertinent question, something that I and the team think about a lot. So, EV is one of the key reasons why we don't have much exposure in autos. We believe auto as a sector, as an industry, has very long sustainable growth, but the winners and losers of the future are very unclear right now. Right, I used to manage US portfolios through the dot-com bubble and through 98 to 2006 was managing money, in the US. Uh, while internet ended up being much bigger or as big or bigger than what we all had anticipated back in late 90s and 2000s, the winners aren't necessarily the same as what we felt or what we thought the winners would be at the time. As one example, AOL was supposed to conquer the whole internet opportunity, right? And now nobody hears anymore about AOL. Many of the FANG companies today didn't even exist back then. And not only the e-commerce companies, but remember the entire networking companies like Cisco, uh, Nortel, and then smaller companies like Sycamore, and then related companies like Intel, and so on, which were the, so, if you will, the FANG companies of the year 2000. Hardly, only one or two of them still have thrived and done very well. Others have gone nowhere. So I think the same problem is happening right now, Udayan. We are assigning multiples and valuations of to companies assuming they are winners. It is too early in the marathon, too early in the race to decide and put all your money onto someone, because as time goes on, new companies would emerge, and other companies who right now are not being recognized might emerge as well, and current companies that are currently anointed as winners might go nowhere. So uncertainty is extremely high at this point in time. I think there isn't it isn't possible to determine who the winners are. So we'll observe for a little while more till we are confident that we found some winners and then make the investment rather than um, shoot first and aim later.
Now, in the event of a small cap, mid cap correction, I mean, we spoke about the 2007 and the 2017 feeling earlier. In the event of a major correction in small caps or mid caps, what we saw in 2017 was a marked shift towards quality. The market became very narrow, and a group of 10 or 15 stocks actually did most of the wealth creation. You do have some of those names in your portfolio, like Asian Paints or Nestle or Titan, those kind of names. Do you see that phenomenon playing out again, where a group of expensive stocks become very expensive again and the breadth of the market completely dissolves? Is that a risk, or do you see this time not playing out exactly like that one?
Certainly, as you'd agree, beauty lies in the eyes of the beholder and value lies in the eyes of the investor. So many of the companies that you noted, when viewed from a cash flow perspective, Udayan, relative to where the market multiples are now, are, I would say, fairly attractively valued, and certainly uh, not the same kind of overvaluation as might appear on a P multiple basis. And companies, if you agree with what I was saying earlier, that some of the companies with weaker governance are overstretched, then even if these companies with solid governance, and not just the few that you mentioned, but the whole host of names out there, even if they don't go up, they would, on a relative terms, might do a lot better than companies with weaker governance. Going up 40-50% is a normal. A normal year is like 10% return. So even if we have a year which is, and since we've had a couple of very strong years, 18% and 14%, it's possible that we may have a very modest year or two going forward. And that those would be years when good companies, could be years when good companies, well-run companies do modestly 5, 10, 15, 20% return, whereas companies which are not well run and poor business models and poor governance might do far poorly as they did in 2018-19.
Okay, thank you so much for your time, Prashant. Always good hearing your thoughts. Thank you very much for finding time today.
My pleasure, Udayan. Great to see you again. Thank you.
Thank you. That's Prashant Khemka of Whiteoak Capital Management, and we shall return next week with another luminary from the stock market. Till then.